Nicky Shiels joins us today. She is the head of research and metal strategy at MKS PAMP, and we're talking about how the metals demand may change over the next year or so. Talking about the drivers of physical demand for gold and silver, and some of the most important macro events that may move the price. Welcome to the show, Nicky. Good to see you.
Good to see you. Thanks for having me, David.
In one of your recent research reports, you highlighted the importance of tariffs on the economy. Importantly, how tariffs could impact trade and the currencies. Now, focusing on the currencies, Nicky, do you expect tariffs, should they be implemented to the extent that Trump has warned that they would be, would tariffs be bullish or bearish for the U.S. dollar?
I think overall the sort of knee-jerk reaction and how the market has interpreted this, especially given the how the euro is traded, obviously the Canadian dollar, MEX, is in the initial reaction is certainly that it's going to be a higher for longer U.S. dollar, which is basically a big headwind for all commodities, including gold and silver going forward. But ultimately, I think you've got to take a step back, right, and look at what they're doing in terms of tariffs and whether it's a bit of a bargaining chip in order to get allies, get the world to the negotiating table. And ultimately, we do think that under America First MAGA regime, you do need a weaker U.S. dollar. So I do think in the short term, we do have a higher for longer USD, but ultimately the current administration, in order for them to implement what they're looking at, we do need ultimately a lower US dollar.
Which is in line with the policy objective of the next Trump administration. They want a lower U.S. dollar. However, we've seen the reverse happen just in the last week when Trump announced new tariffs on Canada and Mexico. The Canadian dollar fell, the Mexican peso fell. In the intermediate term, Nicky, could we expect the reverse of that to happen, which is to say a rise in the U.S. dollar versus some other currency pairs because of capital flows away from those countries?
Yeah, I think ultimately we should expect currency, sort of the currency will not really equity and bonds to be the focus of the Trump administration going forward. And I do think going forward that is where the volatility, macro volatility, is going to stem from. As we react, we talk about the Trump policy. It's a policy paradox, right? So you've got to factor in this sort of chaos premium, and whether it for now is going to be sort of factored into the currency markets, which will overflow into gold and silver to a degree, given there are sort of currency asset classes. So how the market interprets policy, there's a lot of uncertainty over the sequencing of policy, over the positioning of that, and ultimately the ultimate impact on the economic and so on sort of just economic data going forward.
Last week, PCE data came in. Headline PCE was at 2.3, core was at 2.8. What's your outlook for inflation going forward?
I very much in the camp of the Fed does not have inflation in a chokehold, right? They think they do, and I think that this is a big bullish argument for gold going forward, is the fact that, let's talk about developed world inflation on average, CPI is averaging 3%, and you've got the Fed cutting 50 basis points, 25, and expects another 25 in December, when we've got credit spreads where they are, with S&P where it is, where Bitcoin's testing at 100K, gold at 25 plus, and inflation expectations tend to lead. So it is a higher for longer inflation regime. I think they'll be played out in precious metals first, and sort of that is the big bullish argument for 2025. But I think in terms of this decade, we're putting the past behind us in terms of the past 2 decades of a low interest rate, low inflation sort of structural regime for developed markets, and now going forward, we certainly with the policy uncertainty, with deglobalization, de-dollarization, ESG, all these structural forces are coming together to support a higher for longer inflation floor, let's say, going forward.
So what would be a reasonable floor of the level of inflation for you? That makes sense.
Talked about, the target is 2% for the Fed and for most DM. We're averaging now, the average CPI for developed markets core is 3%, and I think that's probably the new floor. So it's a higher floor going forward, and it's this is when it gets tricky with in terms of how economic data will play out in terms of and high inflation going forward.
How aggressive do you think the Fed would be to fight this new higher floor?
Well, for me, it all really depends on the labor market going forward. Obviously, if the labor market sort of plays game and unemployment doesn't rise significantly, then they got more bullets to sort of be on pause or not cut significantly and put forward a hawkish tone. But, the gold prices is sort of indicative of what a lot of gold bulls have been calling for the last couple of decades, is that the Fed is now really backed into a corner. They're backed in a corner because of forward guidance, in sort of really indicating to the market what they would like to do, which plays into sort of the credibility of whether they actually show up and do what they say. And then it plays into the fact that, they were behind the inflation curve on the way up. They may be behind the inflation curve, not on the way down, but again, if we get a resurgence in sort of a 1970s style resurgence in inflation.
Actually, you're not alone in voicing your concerns for inflation, Christopher. Waller, Fed governor, just on Monday this week said that based on the economic data in hand today, in forecasts that show that inflation will continue on its downward path to 2% over the medium term. At present, I lean towards supporting a cut to the policy rate at our December meeting, but he noted that decision will depend on whether data that we will receive before then surprises to the upside and alters my forecast for the path of inflation. So he's not ruling out a surprise to the upside. How many rate cuts can we expect next year, Nicky?
I mean, the Fed told us in September they expect 4. The market is 2. I think between inflation expectations rising, the effect of tariffs and Trump policies on that, it's for gold. There's 2 things that right. Like it's how much. Probably 2 is fair, but again, it's all very data dependent. For gold, the question is, does it really matter? We sat in the beginning of this year and we expected 7 rate cuts, and we went down to 1, and gold still rose one directionally. So it really is whether the Fed is behind or ahead of the inflation curve, which obviously plays out in real rates. And so the view is, I do think the Fed is going to be slightly behind the inflation curve in terms of inflation rising faster than what they're doing, and so real rates should fall.
Well, let's talk about the drivers for gold. First of all, $200 price drop since Trump won the election earlier this month. There must have been a premium that was discounted. What is that $150, $200 premium?
No, I think that's. I mean, you hit the nail on the head there. I think pretty much a lot of it was U.S. election risk. The Trump trade was in full force. It wasn't any Trump trade. It was the expectation that both candidates are sort of free spending. It brings into question the sort of debt and deficit profile of the U.S. And so there was also a lot of talk in the media around it being the most contentious, divided, closest U.S. election in modern day history, which was priced into gold prices, into that $200 premium in the lead up to it. And that was absolutely not the fact. I mean, it was a decisive, it was a quick win. It was against all expectations in the media, in market analysts. So I think a lot of that U.S. political fear premium has been unwound. We had a very decent bounce of 25.50 just recently, and I think for the most part that U.S. political fear premium has been unwound.
Let's take a look at some of the drivers of gold. Traditionally, gold has had an inverse relationship to the dollar. If you take a look at my screen here, that relationship was somewhat inconsistent this year. As you'll see that at some parts of the year, they've moved in tandem, and other parts of the year, they've moved in opposite directions. As you know, if the inflation rate has been coming down steadily all year, and level, while gold has continuously gone up. So that relationship was also not very consistent this year. If you take a look at the 10-year yield, which we can overlay with a gold price, that relationship also, like the dollar, kind of inconsistent. So what has been a good driver of gold that we can use as a barometer into next year?
That question is the core of why gold this year has sort of broken out, because it's done what it's done in the face of such massive sort of macro headwinds in terms of higher US yields and a higher dollar. And it goes back to 2022 when sort of the West sanctioned Russian assets, right? And essentially weaponized the US dollar. And since then, the breakdown between US yields and US real yields and gold has broken down. And you've jump-started a fear amongst mostly BRIC nations, but also sort of Eastern European central banks to begin gold accumulation programs. And central bank buying has been the dominant, the sort of frontliner feature behind this gold rally over the last, since 2022. And while central bank purchases this year is probably not quite on track as the massive purchases in 23 and 22, it's still really steady. And I think it's supporting this higher floor regime, which we're seeing in gold, which is not taking cues from the US dollar, not taking cues from real yields, and begs that question of, okay, so what happens to gold if and when what we think the US dollar does convincingly fall, if and when we get a fall in real rates, that should just add another tailwind or booster to gold in terms of through investment demand, which we haven't really seen.
Well, China was a big driver of investment demand last year, as you know. What do you expect next year going into 2025? Will that force still remain?
So China, so you look at sort of Eastern and Western demand, sort of oversimplifying it. And sort of Eastern demand has been mostly driven sort of a fear premium or fear buying in terms of there's just no alternative assets. You look at real estate, you look at the stock market. It's right now, you look at Shanghai discount or premium, it's running at a pretty steep discount versus London gold. So there's no huge amount of buying currently in China. It has improved from sort of from a couple months ago, but certainly it's not something to write home about, which we talk about on the Indian market, which is extremely strong. So going forward, I think China, obviously what they've done with the stimulus has really targeted the real estate sector, and it's not going to really boost aggregate industrial demand. But what it is it's a huge confidence and sentiment booster to the point where I think you're going to erode some of that fear buying in gold, but you could see what we see in the West in terms of gold becomes part of your portfolio, right? It's just a 1% allocation if we're reinvesting and expanding allocations.
By that logic, could we expect Chinese investors to buy less of physical gold into the future and more of the, I don't know, derivative products like ETFs, for example, if they're available in China?
It's tough to tell. There has been certainly a movement towards physical from the East. It really is a sort of cultural affinity to be more invested physically, whether it's the Middle East, whether it's Southeast Asia, India, China. There is more of an affinity for physical gold. That is the most secure form of gold, to have it, legitimately under your mattress, versus sitting at a bank where the reason you're buying gold is there's a lack of confidence in the system, whether it's the banking system, the political system. So you want your gold outside the system. I don't see much of a change. It's not going to trade in terms of that preference, but in terms of more derivative products, sure, that there could be incremental demand from there.
Okay, so ultimately, what is your outlook for the price of gold next year? Maybe like an average for us.
Yeah. So we haven't published our average forecast yet, but I can talk about sort of the bull bear case. It really has changed pre versus post Trump, in my opinion. In terms of the bear case has got a lot stronger. That isn't our base case. Our base case is still a bull case, where we do see another repeat of 2024. It is not going to be as one way, sort of one directional as 2024 has. It'll be a lot more volatile. And we expect milder gains. Right now, gold is up almost 30% year on year. So I think 22% sort of gains, and we're aiming at 3,200, where I think, gold potentially could hit 32 next year. That's running at 55% probability. And I think the bear case on the flip side is that it could unwind to 2200, which is basically April levels, where the thinking around that is that like peak political and geopolitical fears behind us. The U.S. is legitimizing the crypto industry. The Fed may be ahead of the inflation curve, in which case we'll get a fair amount of just hoarding. So that bear case is building, but it's still not a base case.
If you take a look at my screen here, I'm just going to show you a historical chart of gold. So to your point about $2,200 on the downside, that is roughly a 20% drop for
Right.
current level.
15, but yeah, it's about $400 drop. Yeah.
Yeah, 14%. The fear from some gold investors is that the current price action repeats what happened in 2012, which is to say that there was a peak. Back then, it had rallied. There's a multi-decade rally by an order of magnitude of several times. If you take a look, from the trough of the early 2000s, but then it up something like 40% over the next year and a half. What were the forces back then that led to that kind of drop, and could those forces be in play now?
So the drop, I mean, that was a huge resizing of the gold market in 2013, 2014. We're talking about a European crisis then. China was involved, and then and sort of we entered, if you remember, a sort of a commodity bear market for the most part for about 7 years. I mean, completely different. So macro backdrop. We're talking about it was QE and it was very, very low interest rates. I think the macro backdrop here and the geopolitical backdrop, I think, is the big game changer. And I think, yeah, while we spoke about a European debt crisis, then it was, and we got similar plays sort of occurring now. It's the fact that we're living in a increasingly more uncertain world. Sure, we may get some sort of Trump peace deal with Ukraine or Russia, but ultimately we talk about this policy paradox that there's a lot more chaos around his policies, around global policies, the reaction function. I think that is the big differentiator now versus then. And then the biggest one it will be in terms of central banks. Central banks were not aggressively accumulating gold back then as they are right now. And we don't see any big change in terms of them stepping away from buying programs. Maybe the pace will increase or decrease according to how sort of your geopolitical and macroeconomic forces play out. But we don't see them switching gears completely.
Yeah, central bank buying is key. The other important difference is that now there's a lot more debt on the books of the government. $36 trillion of federal debt. US deficit levels are at 6.5% of GDP, I think. It's widened, and the interest payment alone is more than the military spending of the US. So a lot more debt and deficit from the government now. Does that play a role at all in your calculations?
Yes and no. We've been talking about the debt deficit problem. I looked up an article sort of in 2009. We're still talking about this. I think it's becoming more of a mainstay narrative for gold. Again, it's structurally supportive. It's not yet quite very bullish. And I think once it does, and I think you're going to see that in the currency market when it starts to play out, because the only way out of the deficit problem is a weaker dollar, because you're not raising taxes and you're not getting rid of entitlements in the US. And so the way out is you're going to inflate your way out, and that's a weaker US dollar. So that's when I think sort of the coin drops for investors, and gold becomes more of a mainstay. Right now, it's positioning wise and looking at the technicals, it's still very over positioned from a specialist perspective, but generalists are not overly eager and invested. There's just too many other attractive asset classes out there to be fully invested in gold. So we're not talking about a sort of overzealous, over-positioned market like we were maybe in 2012.
And then finally, let's shift gears now to talk about silver for a few minutes. We've overlaid the price of silver with the price of gold over the last 1 year. You can see that gold and silver have moved more or less in tandem, up 27% for gold and 26.5. So about the same gains in both gold and silver. What is the story and the narrative for silver? Is it just going to continue to follow gold into next year, or is it going to follow some more idiosyncratic industrial trends that are not related to gold?
Right. So I'm fairly more constructive silver into 2025 versus gold. Yes, I'm constructive gold. I think it'll be very volatile. But I think the silver industrial story, which has been the linchpin for silver over the past 4 years, as the world generally just electrifies, and it does play a role in that industrial progress, it is driving the deficit story over the last 4 years. It has mattered to a degree. Yes, we've got silver breaking up through 30, which was a huge feat. But you take a step back and it's like gold traded big figure to big figure this year without looking back. And silver, which is a sort of high beta sister metal that can capitalize on both the fear premium in gold and sort of the industrial cyclical reflation story behind copper, it sort of can sort of attract the best of both worlds. And I think as long as we can sort of rebalance, and with U.S. policy, so it is very contingent on U.S. policy going forward, that the dollar isn't too strong. I think silver does have an opportunity, a window of opportunity, I think, to sort of recalibrate into much higher territory. And we're talking like $35, $40 silver versus $30 to $35.
Yeah, that's a significantly higher, I guess, growth rate for silver than gold.
Yeah.
Wow. So $50 silver is still elusive. We haven't seen that level for more than a decade and a half. What needs to happen to take us there?
You need probably the fact that silver, the majority of silver, so 80% of silver is a byproduct to production. We're already seeing a drawdown in stocks. You need to see physical indicators, whether it's in the forward curve or certain regional premiums spike. And I think it's getting to that point where if we do get a significant amount of investment demand, so that's both retail, coin and bar, but also ETFs taking metal out of the market, it then sort of starts to look a little bit like 2010, 2011, where there's an absolute commodity shortage, and it trades in a backwardation, and prices will have to revert to a much, much higher level in order to incentivize those above bronze stocks back into market.
Yeah, it's interesting how silver in the past reached $50 twice in its history, 40 something years, in the last 40 something years. And it wasn't able to sustain that level. Do you know why?
Like most commodity markets, they all V-shaped top, right? It's not unlike any commodity. If you look at cocoa, you look at sort of all your sort of huge re-ratings in commodities, they're extremely short-lived because supply actually does respond quicker, or demand fades away at those higher levels, and it sort of kills off structural demand. So it's the commodities are a series of V-shaped tops, I guess, is the moral of the story there.
Well, finally, on physical demand, we talked briefly about physical gold demand. What about physical silver? What are the drivers there?
Besides, there's both physical investment demand and then obviously physical industrial demand. On physical investments, it very much is, it's a U.S. story versus Europe, which is a retail coin and bar is more of a gold story. For now, again, it's if we continue with this U.S. exceptionalism theme, U.S. physical retail demand has been pretty soft, but there's reason to believe that there are some sort of, you see the fact that like you've opened up channels, we're now ascending and consumers are buying gold and silver physical at Costco. It's opened up channels to a new audience. Those who traditionally haven't been investing in precious metals now have access to. So sort of what the ETFs did to the industry back in 2005, it's opening up and sort of democratizing the access to physical, which I think is something you cannot ignore.
On that note, you wrote in your research report that the U.S. imports silver primarily from Mexico and Canada. And guess what? Trump just implemented or threatened higher tariffs on both countries. How do you know tariffs and imports of silver, how would that, what's that interplay going to look like?
It structurally it makes you incrementally more bullish, especially silver based in US physical silver in the US. You're now talking about 310, basically about a third of global supply is coming from these two countries. Canada is indirectly from Asia, but that doesn't matter. If they are slapping on tariffs, the price of silver in the US needs to rise a fair amount, at 10%, in order to incentivize sort of above ground holders to restock or destock. Sorry. So I think ultimately what if this does go through and precious metals are not exempt, it really just speaks to the fact that a lot of commodities are not going to be trading. There are going to be a lot of dislocations in the market. It's not going to trade at global price. They'll be trading sort of global supply, regional supply demand balances, and there'll be a lot of opportunities amongst sort of regional premiums and discounts given these tariffs.
Yeah, and you did write that any tariff would negatively impact all North American industrial metal demand.
Yeah.
But further on, you say that, like you said, regional demand, New York metal price rise, for example, that could be expected. Okay, so more or less you're constructive on both gold and silver. Excellent. Thank you very much, Nicky. Where can we learn more from your work?
You can get in touch with me, or I am on Twitter, NexaSA84, and you can get hold of us through our website, MKSPAMP.com.
We'll put the link down below. Thank you very much. We'll speak again soon. Take care.
Thanks, Ida. Bye.
Thank you for watching. Don't forget to like and subscribe.